Your VA home loan can be used to build a single family, duplex, triplex, fourplex, barn dominium, modular house, or even a manufactured home. So in this video, I'm going to go in depth breaking down how you can use the VA home loan construction to permanent home loan benefit to build a multifamily property. This is going to be a good video for anybody that wants to house hack and maybe is having a hard time finding properties in their area that they like, or maybe they don't like the location or whatever it is. Before we jump into that, my name is Dylan Sievering. I'm a North Carolina real estate broker. I am not a mortgage lender, so I can introduce you to a mortgage lender and a real estate broker if you want, but I am not a mortgage lender. So I use this channel and like my TikTok to inform and guide veterans and service members regarding their VA home loan so they can get the most out of it. Me and my family have used our VA home loans in the last 5 years to buy, I think it's over $2.5 million in real estate. That's over 14 doors, over 3 different states, self-managed. So now I use these platforms to show others how they can use it to their biggest advantage. And I do this for veterans and service members from coast to coast all over the country. I schedule calls with vets, service members 7 days a week to discuss their VA home loan transaction. So whether you are buying, building, you want to do a barn-do, if you want to refinance, if you're PCSing, ETSing, veteran, active, National Guard, whatever it is, I schedule calls 7 days a week to discuss you and your goals. So all of my information can actually be found on my website, vahomexprt.com. You can schedule a call there, or my number's pasted everywhere. You can just shoot me a text and email, whatever works best for you. And the things that I will not do, just in case anybody is wondering here, I will not beg you to buy a house. I cannot want you to buy a house more than you do. So, I see a lot of people seem so desperate to get people to buy houses. I'm good either way, really. I'm taken care of. Me and my family are okay. I want you to buy a house. I do. I think every person should own where they live, especially veterans and service members. There's absolutely no reason to be paying rent, but I'm not going to beg you to do it. Second thing, I'm not going to charge you any money. I have never, ever, ever, ever charged a veteran or a service member for anything. I've actually never charged a client. I've never charged a home buying client for anything. So that's not something that I do. I don't even have a way to take payments. And then lastly, I am not going to call you repeatedly. This kind of goes back in the first thing I said is I'm not going to beg you to buy a house. I'm not going to chase you down and force this information down your throat. If you want help, if you want information, if you want to use the VA home loan, I'm open 24/7, 7 days a week. I will make it work to get in contact with you and introduce you to the right people, but I'm not going to harass you. So let's check out what we're going to go over in the video here. But in this video, it's going to be kind of a two-step process. So on the first half of the video, I'm going to talk about the construction side of the multifamily property. So we're going to go over just the lenders and the builders and the land portion and what your closing costs will look like and things like that. And then the second half is going to be how to do it profitably. That's because this person messaged me, said, all the multifamily property in my area is old and in a bad part of town. Can you do a video on how to do it and make it profitable? So the second half of this video is going to be addressing how to make sure you are doing it profitably. Because if you're buying a duplex, triplex, fourplex, chances are you are pro profit and you want to make money off of this property. And you do want to make money off this property. So that's what we're going to cover in the second half of the video. So for those who do not know, the VA construction to permanent home loan. So that is what it's called in the VA home loan handbook, construction to permanent. Sometimes you might hear it construction to perm, but some of the huge benefits are it is a one-time close. So a lot of construction home loan programs have a two-close scenario, once in the beginning and then once at the end of refinance. So you have double closing cost. It can be, quite literally twice as expensive. So VA construction to permanent loan is a one-time close. There's no down payment on any VA home loan ever. So no mortgage insurance on any VA home loan ever. Very, very big opportunity there. And then You can finance the land, so that's probably the most common question I get. People call me every other day and they're asking me about the financing the land portion. So you can put the land into the VA construction of permanent home loan. That means you do not have to buy the land out of pocket. You don't have to already own the land. You can put it into your loan. You can build 2 to 4 unit properties with the VA construction to permanent loan and interest only payments during construction. So that means during the construction period, you don't have to pay the full balance, your full monthly mortgage payment. You're only going to pay the interest portion of that loan. But hang in with me here through this video a little bit more towards the end of the first half, and I'm going to discuss how you may be able to have no down payment and no interest only payments during construction. So that would be no closing costs, and that would be no payment during construction. So hang in there with me a little bit while we go over these details, and I'll get to that. So the requirements for the construction to permanent loan. So there is a 650 credit score minimum requirement and a 55% debt to income ratio max. I'll explain what that means, but before I do that, this is a requirement that is set by the VA. This is not set by the individual mortgage lender that I work with. This is rules and guidelines that are coming directly from the VA, and so nobody's going to be able to lower those. The mortgage lender that I work with actually doesn't do any overlays on the VA guidelines, so this is the requirement. So these are the requirements for the construction to permanent loan with the mortgage lender that I work with. So a 55% debt to income maximum. This just means that the monthly mortgage payment cannot exceed 55% of your current income combined with your other debts. So if you have credit cards or cars or child support judgments, your total monthly debt obligation with all of these combined cannot exceed 55% of your income. So that's what that debt to income ratio is. So it's max, it's capped at 55%. You can't even be 55.1%. There's no exceptions on that. Those are the two hard requirements for the VA construction to permanent home loan. And then this is going to be a brief overview right here of what we're going to cover in the next 4 steps. So we're going to go over the mortgage approval, the finding the builder, the securing the land portion, and then the final step of closing, draws, and construction. So I'm going to try to make this brief. It's going to be a little bit long, it's hard to make things short and valuable at the same time. So step 1, getting approved for this loan. So it is not much different than any other VA home loan or any other mortgage application at all. You're going to need your driver's license, your 2 most recent bank statements, your 2 most recent tax returns, and your certificate of eligibility that's found on your va.gov website. Included with these, you may have to provide like your DD-214 if you are separated, an awards letter from the VA that's showing how much compensation you're currently getting every single month. And if you're still active duty, then maybe an LES, maybe your most recent LESs, things like that. But this is usually enough to get your foot in the door for the application for the mortgage lender to take a look and give you a good idea of how much you can qualify for. And then going back to this debt to income ratio, this is what it looks like on a formula. So you take your income, take your monthly income times 55%. So you only want to look at 55% of your monthly income, and then subtract your debts from that number. That's going to give you your allowed monthly mortgage payment that you may be eligible to borrow. So the second part of step 1 here is how to do this successfully. These are just some things that I've learned in my experience of using the VA home loan in the past. Is make sure that your mortgage lending team is VA approved. So they quite literally have to be approved by the VA to do the VA home loan. It is a requirement, so regardless, they do have to be approved. But working with a mortgage lender that is approved by the VA is not the same as working with a mortgage lender that specializes in the VA home loan and knows how to use the VA home loan to its greatest advantage. So make sure that your mortgage lender that you do end up working with is very, very, very familiar with the VA home loan and its rules and underlays and how it can work in your best favor. It will make a big, big difference. So a couple of things to shop for whenever you are talking to these mortgage lenders is make sure you find somebody that's reputable, as in they have a reputation of doing good work. Find some other veterans or service members that said, hey, this guy did a great job with my VA home loan construction to permanent process. And that is going to be the tall tale sign right there. Find somebody that's reliable, as in you are able to rely on them. This is going to be a dead giveaway in the beginning stages of meeting this mortgage lender. Whenever they say they're going to get back with you, or they say they're going to give you some documents, or they say they're going to send something over. Being reliable means that they are going to do the things that they say. So finding a mortgage lender that is reliable on the front end is very, very, very important, because when things get hard, when things get stressful, it's very important to have somebody that is reliable. And then lastly, responsive. Are you working with a mortgage lender that is just going in Monday to Friday and turning their phone off on the weekends? That's not good. Problems don't wait until Monday morning at 8 a.m. So make sure you have a mortgage lending team that's on the phone, will answer your calls evenings and weekends and holidays, and will be there to guide you through the process, because things will go wrong. It's going to happen, and you need to have somebody that is and you need to have somebody that's reputable, reliable, and responsive. Very, very, very important. This is what makes or breaks a deal, undoubtedly. And that can also go hand in hand with your real estate broker. Make sure your real estate broker is a reputable, reliable, responsive person, because your lender and your agent are going to go hand in hand in your transaction, and they will make or break a deal. So even if you are building a house, you're going to have to find the land, and relying on that real estate broker will make your life a lot easier. All right, so that's step one. Step one is the mortgage approval. Now we're going to move into step two of the finding the builder. So just like the mortgage lender, the VA has a list of approved contractors that are approved to do the construction to permanent VA home loan and build houses with this loan program. So this is public information. You can find the list of approved builders, and it is sectioned by their state and county, and I think it has their phone numbers on the website also. So you can figure out where in the country they are building, and they are already approved. So that is a good thing. That is public information. But so once you do find this builder, of course, in this scenario, it's going to make the most sense to find a builder that does multifamily properties. I've had success in the past by just calling the multifamily building companies that I see building them actively right now. If a builder is doing it in the market, it is not a theoretical practice. It's somebody who is building multifamily properties currently. So they currently have it on their mind. They currently know what to do. They currently know what not to do. They know what's not working. So that's a pretty easy process, and they can be put on the VA approved list. It's fairly easy. So once you do find this builder, you're going to have what's called a builder contract, and we're going to go through here this list of things to expect on this builder contract. So number one is going to be a scope of work, which is going to be a clear-cut list of what this builder is going to do. Price and payment schedule, so clear timelines of when things are going to be done, when the next draw is going to be taking out, and how much, so that everyone knows when things should be done and how much money is going to be moving at that time. Change orders, so rules and what the rules are and the practices are if a buyer, if you as the buyer want to change something on the property, what the operating procedure is for if that happens. Timelines and delays, so if timelines are going to be pushed to the left or to the right, how does that affect everything else? Is that going to cost money? Who's going to pay for these problems? What if it's weather? What if it's my fault? What if it's the builder's fault? So warranties. It's going to cover and discuss the warranties on the labor and the product that the building company offers on their work. Dispute resolution. So if you get down the road and there is a conflict that is not addressed in the contract, how is this going to be resolved, in the different avenues that it can be resolved. And then surprises on the lot, so dirt work or rocks, or if there's an oil tank is common. I see that sometimes here in North Carolina. So if just unexpected surprises, again, who's going to pay for it? It's usually going to come down to money and time. So how much time is it going to push the contract off, What do we do if that happens, and who's going to pay for these things? So all of these things are going to be addressed in this contract, but it's important to understand that an attorney is helping these builders draft and compose this agreement and this contract, and it is highly advised that any buyer or borrower or VA home loan borrower is taking this contract and discussing it with their real estate attorney team, because if you are buying especially if you're buying a property in North Carolina, you're going to be closing with a real estate attorney that you're paying for regardless. So make sure that your closing attorney is looking at this contract before you sign it and giving guidance as to whether or not it's a reputable contract or if it's putting you in the best position. So that's a builder contract. Those are a few things to expect on there. And then the second half of part 2 here, or step 2 rather, with the builder is you're going to be picking the floor plan and determining the cost to build. So before I move into the floor plan scenario here, the cost is going to be outlined in that builder contract. You're going to have a lot of these details already covered. So you're going to have a lot of the floor plan and the details and the customization. That's going to be discussed beforehand prior to the builder contract. But I always say that there are 3 different types of floor plan, and they're going to be the base model, which is going to be the base model, the semi-custom, and then the fully custom. So, and then as you guessed it, as you move up there from base to fully custom, the prices are going to increase. So it depends on your unique scenario and what's important to you. If you want to have the most fully custom house and maybe you have some money to dispose and it makes sense for you, hey, whatever makes most sense for you at that time. But that's typically how I've seen it in the past. So putting it all together here. So at this point, we know how much we're allowed to purchase. We know our mortgage lender has approved us for a certain dollar amount. And now we have a builder contract, so we know how much it's going to cost for us to build this property. So what we can do now is we take our approval amount and we're going to subtract our cost to build. And that is going to give us our land budget. Okay, let's look at what that looks like. So step 1 is our allowed purchase price. So the mortgage lender has approved us for $450,000 in this scenario. So now we're going to subtract our cost to build. We'll say that in this scenario, the build is going to cost $375,000. So we're going to take the $375 minus from the $450, and that is going to give us our land budget of $75,000. So based on this scenario, we have a budget of $75K to go and find our land. But hey, make sure you stick around until towards the end, because I'm going to show you why it's going to be more beneficial for you to keep that land budget as low as possible. So don't miss that part. It's very, very, very important. And hey, by the way, if you are watching right now and you're really into this and you're digging this video, I really, really, really hope that it's very valuable for you and it helps you achieve your goals of building, buying, using your VA home loan benefit to become a property owner. I use this channel to spread factual information to veterans and service members across the country in every state. So just by liking, commenting, sharing, subscribing to this channel, it will help this information be pushed out to the right veteran or service member, and it could change their life. So right now, real quick, like it and subscribe to this channel. It would mean the world to me. Thank you. Moving on to step 3 is securing the land. Like we just saw in the last scenario, you have your land budget. We want to stay low in our land budget, as low as possible. But some things to consider when you are shopping for land and you're going to be moving forward and buying land is, number 1, rely on your real estate broker. I've done several home buying transactions and I've never, ever, ever, ever once been paid by a buyer. I've always negotiated the seller to pay me for representing the buyer. I'm very confident that you should be able to do the same thing as long as your real estate agent is doing a decent job. So go find a real estate broker that you know and trust and does a good job. If you want, I can introduce you to one, but they will have access to the MLS and they can show you properties that are on the market actively for sale. And then determine what you need. So this is going to go back to working with your builder, but whenever you find some land, figure out, are there utilities on the property right now? Is there water? Is there sewer? Is there power? If not, is there well or septic? Does it need a well and septic? If it's already there, When's the last time it was inspected? Does it work properly? To install a septic tank, you have to have a perk test on file. Does the soil perk? If so, a lot of people, I don't know if a lot of people know this or not, but the septic tank is what determines the allowed size of a house that can be put on a property. So, if you are out in the sticks and you're trying to build a multifamily property, not very common, but I guess it's not impossible, and you do have to rely on a septic tank opposed to public sewer, you want to make sure that the land can support a 2, 4, 6, 8 bathrooms. That would be a lot for a septic tank. So something to consider. Again, with the land, dirt work. So if you have a good relationship with your builder, maybe have them come out to the land before you're submitting offers and say, hey, what's this going to cost to prepare this dirt for our foundation? Easements, something to consider. You're going to rely on your title company to do a title search and see if there's any easements on the property, see if anybody else is claiming ownership to that property. Road access, very, very important. You want to make sure you're able to get to your property. Make sure your tenants are able to get to your property. Make sure you're able to get mail. Make sure you're not landlocked. So road access is very, very important. And then lastly, zoning. So if you are going to be building a 2 to 4 unit property, duplex, triplex, fourplex, usually the zoning for that property is going to have to be very, very specific to whatever your county or local municipality is. So making sure that the zoning allows that type of property to be built is important. But once you have done this can all kind of be wrapped up into what I call due diligence. But once you're done with your due diligence, you can submit an offer and go under contract. And some of this stuff that I just discussed here, that'll be done while you're under contract, and some of it will be done beforehand. But determining these things and figuring this out is an important part of buying raw, vacant land. But you submit an offer and you go under contract. So right now we have discussed being approved by a mortgage lender. We've discussed finding a home builder, picking floor plans, and really covering all bases of timelines and costs and expectations. We have found our land that we want because we know what our budget is. We know that we can finance the land up to a certain dollar amount, so we've secured our land. Now we're going to move into what the closing, draws, and construction process looks like for this multifamily build. Let's check it out. So again, going back to step 3, once all your due diligence is done and your mortgage lenders have signed off on everything and the land is clear of all title issues, any easements, road access, zoning, everything's good to go. And you're going to go to closing, which is you're going to be signing documents to transfer the land into your name, and you're agreeing to taking on that mortgage for your new construction. So that's what closing is going to be. And this is where you're going to have your closing costs. So just a brief overview of what the closing costs are going to be. Just like every other VA home loans, you're going to have your origination cost, your settlement cost. You're going to have your title insurance for your lender and for yourself, your taxes and insurance prepaid. You may have some inspections and appraisals and some other costs, maybe a funding fee if you don't have any VA disability at this time. So these are what these closing costs are, and this is where you are going to see them. Now, I know somebody out there is like, wait, I thought you said that I don't have to pay closing costs. Stick around, hang in there with me a little bit longer. I'm going to address these closing costs and the interest-only payments. Just hang in there with me. We are going to get there. So that's closing. Once closing's done, you're going to go to your construction and draws. So your draws. A draw is a financial agreement that breaks down a project's total cost into incremental payments. So what that means is during the construction process, the VA home builder that you choose, that you hire, is not going to receive the entire lump sum at one time. That would be absolutely fucking terrifying. I couldn't imagine taking on $400,000, $500,000, $700,000, $800,000 and just giving it to this one guy and just being like, hey, I hope you build. So they do what's called a draw process. Typically, it's going to be from 4 to 7 different draws throughout the construction process. Line up with the key components of a house. So, your foundation, framing, HVAC, electrical, plumbing, roof, and then interior finishes. So once each one of these is done, the contractor is going to call to have the inspector come out. They're going to get the stamp of approval, and then they're able to take the next draw from the funds at the closing attorney or at the title company or at the lender. So that's what a draw is. So inspections are conducted between each draw to verify the work is complete before moving to the next step. It seems like a giant inconvenience, especially if you're being your own general contractor, but it is certainly in place. This rule is certainly in place to protect you as a borrower. You don't want to give somebody all of your money and then just expect them to do the work. This rule is in place for a reason. Unfortunately, a bad reason. But that's what a draw is. And then we'll go over the construction. Of course, the construction is just the process of building the home. Going over those 5 major components that we just discussed of the foundation, the framing, the HVAC, electrical, plumbing. Those are the 5 major components of the house. And but most importantly, once the construction is completed, so once everything is done, all the inspections have been done, all the draws are completed, there's going to be the final inspection, and then the county is going to issue what's called a CO, or a certificate of occupancy. Once your certificate of occupancy is issued, you guessed it, you can move into your property. Then within 45 to 60 days, your mortgage payments are going to begin. So thanks for hanging in there with me. Right now, this is where I'm going to go over the closing cost and the interest-only payments and how you do not have to pay them, hopefully. All right, so closing costs and interest-only payments. So the guideline for the VA construction and permanent loan does state that interest-only payments during the construction process is an option for the borrower. But interest-only payments and closing costs can be put into the loan for the borrower as long as there's enough room. Remember, referencing the land, I said we want to make sure our land doesn't take up our entire budget. So if we have any money left over, we can have no down payment on any VA home loan ever, have no closing costs, and no payments during your construction. This will allow you to not have to pay 2 mortgages or pay rent at one place and a mortgage on your unbuilt home. This will allow you to live comfortably during your construction process. I've heard people say crazy things like they want to buy a trailer and move on the property in their trailer during construction, or they don't want to do a double, triple move. They don't want to rent and let their lease expire for their timelines to be pushed. This will allow you to live comfortably and not have to pay for 2 places at one time. So huge, huge, huge benefit. Make sure you don't overextend your budget to the point that you cannot put these things in your loan. You know, it may only be $25,000, but it will be, it could make a huge, huge difference on your construction process. So let's look at what that example looks like. So in this scenario, we'll say that you were approved for a $500,000 mortgage. You found a builder and your floor plan was $400,000. Secure the land. So now you found land for $50,000 and you can put your property on it. So the next thing is you're going to want to take your floor plan price subtracted from your mortgage approval and take your land subtracted from your mortgage approval, and that's going to give you $50,000. So this is your budget for your closing cost and your interest-only payments. Now, almost all of these numbers are going to be different for your scenario. Maybe you're approved for more, maybe you're approved for less. Maybe your floor plan and building cost is more or less. Maybe your land is more or less. So every single scenario is going to be different. Don't put a lot of thought into these numbers. These are just easy numbers to understand. But understand the concept of you can move around maybe you need to talk to your mortgage lender and say, hey, how can I get approved for more money? What do I need to do? Do I need to sell my car? Do I need to pay off this credit card? Maybe go talk to some different builders who have a more affordable floor plan. If you're on the most base model package, maybe you can go find a different builder who has more affordable programs. Maybe you, instead of buying the more expensive land, maybe you push out to the outskirts of town 10 or 15 miles and you're in a less populated area, but you have a lower land cost. Whatever you have to do to make these things work to where you're able to put your closing cost, your prepaids, your interest-only payments, put everything into the loan at closing. It could save you a ton of time and definitely a ton of money. So that's what that formula looks like. But that was a lot. That was 37 minutes. That was over half an hour of going through the process of how to build a multifamily property with your VA home loan benefit using the construction to permanent loan. So if you're still watching this video and you didn't do it before, just go ahead and like it, drop me a like, and then comment the city that you want to build in. That's all I want you to do. Like it, and then comment the city. Next, as I promised, the second half of the video, we are going to discuss how to do this profitably. So I imagine a lot of people probably want to know like the secret sauce on getting things more affordable and how to really make it like a rock star slam dunk profitable opportunity. And the truth is, I don't have the secret sauce. I don't think there is a secret sauce. The closest thing to the secret sauce is become extremely analytical. Fully understanding the process and understanding your approval amounts will give you the power to really, really measure everything and know what's in your best favor. So, when I say become analytical, determine your cost, your monthly cost, and your out-of-pocket expense. So what's it going to cost you out of pocket up front? We just went over a lot of that, so I'm not going to cover that again, but we will cover what your monthly costs will look like and how to calculate those in advance. And then also market research is incredibly important. So, what are the rents? If we're talking about building a duplex, triplex, fourplex, you should be very, very in tune with what the rents are in these areas that you do want to buy. How much does the land cost where you want to buy? What are the permits costing? You should be very, very in tune with what these things are, what's going on in your areas that you want to buy or build. And then most importantly, make a plan. Profit. You want to be profitable, but if you don't have a plan, how do you know if you're winning? So, make a 3, 5, 10, 30-year goal for what you want to do with this property. Maybe 5 years down the road and it's appreciated 20%. Hey, take your 20%, you sell and you go do it again. Maybe you want it for your kids and you hold on to it for 30 years and it's paid off. Maybe you want it for your retirement. So make a plan for this property and it will help you determine if it makes sense for you. But let's look at your costs here to determine a property's profitability. So your monthly costs, the very, very first thing to mention is the principal, interest, taxes, and insurance, or PITI. This is what your monthly mortgage payment is made up of. So understanding what your PITI is going to be is crucial. So if you are starting off and you have a mortgage approval, chances are your mortgage lender has a pretty good idea of what your interest rate can be, and based off your credit score, can tell you about where you're sitting at on a potential mortgage payment. So understanding what your PITI is on the front end is crucial to determining how much money you're going to make. Property manager. Maybe you're full-time employed and you don't want to manage tenants every single day because tenants do need things. Shit does break. So maybe you don't have a bunch of tools, or maybe you don't want to manage people. That's totally fine. If you have a full-time employment, you have a family and kids, these things can get in the way. So if you're going to hire a property manager, how much are they going to cost? Go find one. Call property managers in your area and ask them how much they charge to manage a duplex, a triplex, fourplex. Reserves. Sometimes a lender is going to require that you have an X amount of dollars in the bank before they can lend you more money. Maybe some people like to keep a certain percentage of reserves on hand as a safety net. HOA fees. So if you are buying land in an area, maybe they allow multifamily properties, but they do have an HOA fee. That's something to be considered in your monthly cost. Utilities can be a huge factor. So if you're building a property, please meter them all separately. But if for some reason you can't do that, who's going to pay for all the utilities? I see in a lot of these older properties, they're not metered separately, but they are addressed separately. Maybe it's like a Frankenstein or a Reno, where they have multiple units in the property, but not multiple electric meters or water meters. So, determining who's going to pay the utilities, that can be a huge expense. This is what I use right here. This is a spreadsheet. I call it an analysis template. So you can see in the top here, all the yellow fields are what needs to be inputted to get the final result, which we'll go over here in the next few slides. But you can see you put in the sales price, so then it'll show you the loan amount, and then you put in your interest rate. And then you can go through here on the right and figure out, and you can input your monthly taxes, your monthly insurance amount, and then there's a checkbox that I put in there for if you're going to pay property management, reserves, electric, trash, HOA fees, capital expenditures. This is a really good way to categorize your expenses and really look at them all in one place. So that's what I use. So the next part to making this profitable is market research. So whenever I'm looking at multifamily properties or I'm analyzing duplexes, triplex, fourplexes, whether it's for myself, a client, or my family, I use Zillow and Apartments.com. So both these websites, Zillow, you have to go to the rent button. So once you click the rent in the top left corner, and Apartments, you just put in whatever area you're looking. But once you do that, it's going to show a map of all the rentals in that area that people have advertised right now. So it's a huge, huge database of just properties for rent in most areas. If it's highly populated, chances are that they are listed for rent on one of these two websites. So what I do is I go through these and I just find comparable rental properties. So you can start labeling monthly rents to property types. 2-bed, 1-bath properties are renting for this. 3-bed, 1-bath are renting for this, and the list goes on. But it'll give you a very good idea in your area of what things are currently being rented for. And as time goes on, it will adjust. But a couple things to consider when you're doing this is your current condition or the year built. So make sure that you are matching apples to apples. So you want to make sure, like I just said, beds and baths and the square footage and the amenities like a washer and dryer, a pool and internet, utilities like we just discussed before. So making sure that you are not getting a false idea of what the rent could be. Make sure you're just very, very thorough on doing your market rental analysis. Yeah, so putting it all together, once you've determined your monthly cost, like we just showed with the capital expenditures, reserves, utilities, taxes, insurance, and you have your potential market rent determined, you can put it all into the spreadsheet, the same one before. I'm just showing you everything here. So below the expense column is going to be the rental column. Pretty self-explanatory. Put the rent in, and then at the very bottom, it's going to show your debt service or your monthly debt obligation. And then in the top right, you can see owner occupied while living there versus non-owner occupied after you move out. So this whole entire spreadsheet will show you in one place. It'll show you your net operating income, your monthly and yearly cash flow, your cap rate, your total incoming rents, your monthly debt obligation, and all of your expenses all in one place. I spent several years kind of fine-tuning and crafting this. And then in practice, this is what it looks like. This is document for a property that I bought. I made this document before I even purchased this property. I spent probably hours looking at this and analyzing it. So I knew what my rent was currently and what it was projected to be. I knew what my expenses were going to be. I got an insurance quote from my insurance person. I checked the county website for the taxes. So this is how thorough that I am whenever I'm purchasing multifamily properties. This is how I suggest my clients do it. And this is how I suggest that you do it to determine if this is going to be a profitable purchase or construction for you. I hope that this video has been valuable for you. And my name is Dylan Sievering. I'm a North Carolina real estate broker. I use these channels to inform and guide veterans and service members on how to use their VA home loan benefit to the fullest advantage, whether that's buying, building, investing, duplex, triplex, fourplex, barndominium, modular, manufactured, whether they're in Washington, Oregon, California, Arizona, Nevada, Idaho, Utah, Montana, Wyoming, Kansas, Iowa, Missouri, Nebraska, Tennessee, Colorado, Texas, Missouri, Florida, Georgia, North Carolina, South Carolina, Rhode Island, Maine, Connecticut, New York. I help veterans all over the country. I schedule calls with veterans and service members 7 days a week to discuss their VA home buying opportunities. So if you want to use your VA home loan, again, I'm not going to call you every single day to beg you to buy a house. I will not charge you. I have nothing to sell you. If you want to buy a house, you want to do it the right way, you want to work with a professional team, I would love to help you, introduce you to the right teams, the right brokers, put you in the best position possible. So thank you for watching the video. I hope it was valuable for you. Let me know in the comments what you want to see next, what's giving you a hard time, or what you did not like about the video. See you next time.